I'm Greg Hunter. Welcome to USAWatchdog.com. With us, the CEO and founder of Matterhorn Asset Management. You can find them at goldswitzerland.com. I'm talking about Egon von Greyerz. Egon von Greyerz, thank you for joining us today on USAWatchdog.com.
Greg, always a pleasure to speak to you. I look forward to it.
I took extra special time setting this up, making sure it was framed just perfectly, and you were perfectly moved over an inch or whatever. I said because this is like TV, and you're not going to hear this on mainstream media, and this is a pivotal time for you. I mean, we're coming to the end, are we not, with the funding problems that the Fed is having, that the mainstream financial media is not talking about? They're having funding problems almost every day.
Well, the central banks are panicking, Greg. They are, they don't know what to do anymore, and still they're just starting slowly now to print money. The US on a daily basis with their overnight repos and lower interest rates, and of course Europe is starting proper QE again with 20 billion a month. But that's nothing, Greg, to what is coming because I am absolutely certain, and I talked about this in August already, that we are looking at now, relative to gold, we're looking at a situation which is very similar to August 1971, when Nixon took away the gold backing of the dollar. And I think that the panic that started among central banks in the summer, late July and August, was to me the first step towards a total chaos that we will see in the world in the coming months and years. And they see it clearly. They know that the banking system is absolutely on the verge of collapse. They know that Deutsche Bank, which is now down, as we know, 95%, and Commerzbank too, anything that goes down 95%, if you just look at a chart, even a child could say, where is that likely to go? It's likely to go to zero, Greg. So Deutsche Bank, and of course with their almost 50 trillion derivatives, there's no chance that they will survive. And of course Germany, the Bundesbank, the ECB, they're panicking because that will affect the whole banking system worldwide. And this is why they're starting to print money now. There's a massive liquidity problem. And that's Germany, which is the best country in Europe from the point of view economics. Then you take Italy, you take Spain, you take France, you take Greece. They're in a real mess. That's why the whole system is totally now on the verge of disappearing into a black hole. And of course, the US is now also, as we said, started the same with their repos. And there's massive liquidity pressure in the system there. Of course, there will be with all the massive extension or expansion of credit we've had in the last decade or two.
Do you think the Fed is, they said they were going to organically grow their balance sheet. Some people said, oh, they're just doing that to, grow the money as the economy grows and all. They're not, well, no. They said they were going to start organically growing their balance sheet. They've already announced it. They basically already announced QE, but aren't these overnight repo operations, this funding, this money printing to buy bonds, isn't this really QE already started with the Fed?
Yeah, of course. Of course it is. So now it's overnight repos, and then you have the fortnightly repos that they're also starting. This is just a practice round. This is small money at this point. Their balance sheet of the ECB, of the Fed, is going to go from around the 4 trillion. I mean, it's going to go to 40 trillion. It's going to go to 100 trillion before this is over. So right now, well, they're just practicing a bit because they're going to put the pedal down to the bottom very, very soon or in the next few years, because there's no other way to save this system. It's gone too far. I'm not a pessimist. I don't want to see the end of the world, but you can see their actions, and you can see that now there's absolutely no way out. The only thing they know is to print money. And okay, they reduce interest rates to zero, which is or negative, which is a disaster in itself, and that doesn't help. And now they're going to just print money, and that's sadly, it's going to be the end of this financial system as we've known it at some point in the next few years.
So you wrote a great piece that was on King World News, fabulous piece, and you were talking about how housing has really gone down. It's depreciated relative to ounces of gold. and you think that gold's going to keep appreciating at 15% a year relative to fiat currency. Will you explain about how housing is depreciating and people aren't saving? They can borrow money. I mean, what is it in Holland, I guess, or Amsterdam, or wherever it is over there? You can get paid to borrow money, or you can borrow money at 0%. Can you explain what's going on in housing in Europe? Because it's just so people know. I know you vault gold on a couple of different continents, and you have Matterhorn Asset Management, found at goldswitzerland.com. But you also have a couple of decades in banking in Europe as a top banker, just so people understand that. So, can you explain why the housing is gone down so much relative to gold?
Well, what has happened since the turn of the century, of course, when gold just bottomed, since then, the world central banks have printed amounts of money that we have never seen before, which basically means that everything that's valued in paper money has since 2000 gone down against gold. We know that gold is the best performing asset in the world since 2000. And that's only because of this credit expansion, which has been unlimited and is now, world global debt, Greg, was around 80 trillion at the turn of the century. Global debt in 2006, when the crisis started, was 125 trillion. And today, global debt is over 250 trillion. So it's trebled since the turn of the century and doubled since 2006 when the financial crisis started. And that's why paper money is going down at the fast rate. Nobody understands that, nobody knows that, but this is how then you can't measure house prices or stocks in paper money anymore, because that actually is not a proper way of valuing these assets. So therefore, the only way to do it is to do it in gold, because that's real money, that's stable purchasing power. Now, so therefore, stocks have gone down against gold since the turn of the century, quite dramatically, but by more than 50% since the turn of the century, and so has house prices. Not quite as much as 50%, but they're also down. That's just the beginning. Just you wait, because in my view, all of these bubble assets that are based on just credit and credit expansion are going to implode, measured in real terms, measured in gold. So I expect both the stock market and the property market to lose from here on 95% at least, and probably more in real terms. That means that, let us take a house today in the US that is worth $1 million. That's about, let's say that's 20 kilos of gold. That house we will be able to buy in a few years for 5% of that, which is, i.e. has gone down over 90%. So you'll buy it for one kilo of gold instead of for 20 kilos of gold. And that's what's going to happen to all these bubble assets. It's going to be the same with the stock market. The stock market will also come down by more than 90%, probably 95% at least, against gold in the next few years. I know nobody believes this. I know everybody will think it's scaremongering, but because nobody understands that actually it's not that gold is going up in price, it's only that paper money is totally being destroyed by governments and by central banks, and will continue to do so at an accelerating rate in the next few years, Greg. Coming back to your negative interest, yes, in Denmark, you now can buy a house and finance it at negative interest. Just 0.1%. So the bank actually pays you. I think they cheat a bit so that your fees probably will equal that 0.1%. So you pay nothing. But this is a sick situation. Who's in the end? Negative interest goes up to 25%, and after 4 years, the bank has paid you off all your debt. They pay you 25% a year. Can you see how ridiculous this is? And then therefore, why should it end at minus 1% or minus 2%? I mean, they can go on forever. And in the end, as I said, you're being paid to borrow money. And of course, that's what the governments like. They like to be paid to borrow money. But what they don't understand is that in the end, no one will save any money, because savings, if you study economics, you learn that investments equal savings. Investments don't equal credit, because then you go bust. So investments equal savings. But if you take the Germans, they're not saving. The Germans are not saving anything now with a negative interest rate. So there'll be no investments in Germany, and it'll be the same in all other countries.
Because and the only way you can save, let me get this right. This is a very important point. The only way you can save is if the money is worth saving. And what you're
Correct.
saying is the money is not worth saving.
Absolutely. Absolutely. Because you get now people who save get nothing, and their money is being destroyed on a daily basis. So why should they save? But the problem is, what should they do with the money, Greg? There's nothing, all they can do then, and that's what banks do too, and that's what investors do. They invest in more and more risky assets, which will exacerbate this whole situation and make the collapse even bigger. It's a vicious circle, and my views, and I mean, it's not a laughing matter. But if you look at it from the outside and look down, I mean, you think that there is a number of madmen down there running the world, because it just isn't possible that this breaks all the laws of nature, all the laws of supply and demand, all the laws of sound money principles. And it's happening right in front of our eyes, and nobody even talks about it or realizes it.
They say that they say that the Fed's going to fix it, the ECB is going to fix it. They're going to have total confidence in it. There's something really big different this time than 2008 or even the Great Depression. We have $17 trillion in negative paying interest largely in Europe. None in America, thank goodness. I don't know if they're going to be that stupid to do. They keep saying, "Oh, they're going to take rates to zero and negative in the United States." Really, after what's going on in Europe, they're going to take them to negative? I mean, can you talk about the problem with the negative interest rates, the 17 trillion in Europe?
Yes. Well, central banks haven't got a clue how to solve this, and they're trying to stimulate economies around the world by, well, as they say, creating inflation. Well, they're actually, with negative interest rates, you're not creating any inflation, because nobody's going to save anything. No one is going to earn anything on the money, and the demand. I mean, people don't have any money. People don't have any money to put in the bank. People don't want to borrow money even at negative interest rate, because they know they can't afford to repay it. And this is, and we will see more negative interest rates, and we will see whether the US will get it or not. I'm not sure. I'm still always looking at this credit cycle that is 35-year cycle that bottomed in around 2015 or so. The interest rate bottomed, and I wonder if we are going to go much further down. I know central banks want to, but my fear is that at some point, maybe they'll take another year or two, but the weight of the debt is going to crash these bond markets and these debt markets. So they're not going to be able to hold the interest rates down for very long. And when I say very long, it could be a year or a couple of years or maximum 3 years. I don't think it'll be that long. I think interest rates are going to surge, and then we get into the hyperinflationary stage, of course, when the money printing creates the hyperinflation. That is inevitable. So there's no chance that they can have this quiet equilibrium that they think is equilibrium, but it's a massive imbalance of the financial system. I don't think it's going to last that long, and whether the US rates come down a bit further or not in the short term, that's irrelevant. The weight of the debt is going to crash these markets, and that will mean that initially it'll be the long end of the bond market that will crash, because that's more difficult for the central banks and for the Fed to influence. But then, of course, when long rates go up, so will short rates. They will be pulled up by the long rates. And I see, a massive, this is the biggest bubble in the world, the debt market, the bond market. And of course, that will absolutely, is inevitable that has to crash in the next few years.
Is that what they're doing with the repo market? You know, you see these overnight rates spike to 10%. I actually called Rob Kirby about this. He says, listen, if it goes on a couple of days, he worked in the derivatives market back in the day, at the very beginning of derivatives, and he says just a few days. Now, if this keeps going on, you know, for a week or 2 weeks, then you got a problem. Aren't they really trying to hold the interest rates down? Aren't they really not trying not to get the debt to go out to market and have people bid it up, and then all of a sudden you have a 3 or 4 or 5 year, 10-year treasury? Isn't that what's going on? Or explain that to me.
Yeah, no, you're absolutely right. You know, the derivatives market, which I estimate at 1.5 quadrillion. I mean, this one day change by the BIS, by the Bank of International Settlement in Basel, from 1.4 trillion about 7, 8 years ago to half of that in the total derivatives outstanding in the world. They just made this adjustment because it looked better. But I still consider that we are at least 1.5 quadrillion, and probably a lot more now, but we never get any real figures. Now, the biggest part of the derivatives market is the interest market. First, the interest derivatives are the biggest, but every single derivative has a major interest element in it. And you know, derivatives function, Greg, when there is demand and banks sell derivatives, i.e. to clients. They produce them and sell them to clients and earn massive margins. I mean, this is where all the banks earn absolute fortunes on the derivative. The day the market turns and the people want to sell or liquidate their derivatives, there will be no liquidity. And that will, I think, happen at the same time as interest rates go up. And at some point, and this is what's going to cause the real money printing, at some point they will have to print money to deal with the gross value of derivatives, not the netted off value. And then you're talking about printing money in the hundreds of trillions or more. And I think there's a very good chance, sadly, that this will happen. You know, let's just take another derivative that is closer to me, which is the gold derivatives. I mean, are people aware that the gross turnover of the BMA banks in gold on a daily basis is $280 billion. $280 billion. That is 850 times daily mine production, Greg. So
Wow.
they are turning over 280, of course, billion, and obviously none of that is paper. There's no chance that, none of that is physical. I mean, there's no chance that that's any of that is physical. So, but to me, that is an indication of real problems also in the gold market, because there's absolutely no reason to turn over 850 times daily mine production in gold. So I think they're juggling with the positions of the central banks and the IOUs of the bullion banks or the central banks who are borrowing their gold. Let me give you another example. Some of you, who was it that talked about ETFs? So was it Nick Banish?
Yes, I couldn't
Yeah.
believe this. He was saying that Dalio and what Mobius and all these other big investors. I don't know. They're buying ETFs, and I've read the prospectus,
Yeah, they are.
and they're going to get a pie in the face.
Let me explain
Basically, go
to you. Let me explain to you. So the gold ETFs. Now we buy physical gold only, and store it outside the banking system, and we buy it straight from the refiners in Switzerland. The Swiss refiners produce 70% of all the gold bars in the world. So we have
Wow.
a we have a very good feel on what's happening in the physical gold market.
Wow.
Now, the Swiss refiners have had very slow business in August and September so far. They actually have stocks. They're seeing gold coming back. They're seeing, obviously, scrap is always coming in. So it's hard to believe. Gold has gone up. ETFs have only in August, ETFs I think has something like 122 tons of gold, which is increase, or the GLD had 122 tons, which is over $5 billion. And the refiners haven't actually delivered any gold. They're actually seeing, very, very weak sales in physical gold. So that confirms what Nick said in your interview, that the refiners are, sorry, ETFs and the GLD are actually not buying any gold at all. So when the ETF goes up and people who are buying ETFs are absolutely mad because they don't have any physical gold. All that's happening is that, as in these bullion banks, whether that's the HSBC or the JP Morgan, whoever it is, they just shift the gold from one side of the floor to the other. I don't think they even shift it, only on paper. So it's because these banks also hold central bank gold, and they probably commit or lend that several times over to the ETFs, so that then the ETFs can count that as they have a commitment from a central bank to have gold, and that's all they need. And that's Nick mentioned a similar thing also. So this is why the refiners are not, in my mind, this is how I read this, the refiners are not seeing any increase in gold demand in spite of all the ETFs reporting high increase in sales. So so they're cheating too. It's the whole blessed world is built on derivatives, and also the gold world. So anyone who wants to preserve wealth should not own paper gold. And ETFs, in my view, I know a lot of people don't like hearing this, but ETFs, in my view, is just another form of paper gold. To have a commitment from a bullion bank that they will deliver gold to you, or from a central bank that they will deliver gold to the bullion bank who will deliver it to the ETF, that's not good enough to me. That's not the way to own gold. And then we have, of course, which I discussed before, we have before all the gold stayed in London, mainly in the LBMA pool there. Now China is the big buyer, so the bullion banks borrow gold from the central banks, but before it stayed in London. Now all of that gold is delivered to China, to India, to Russia, etc. And therefore now all they have again. They borrow it from the central banks, and then the bullion banks give the central banks an IOU. That, of course, will never be honored because now the gold has gone out of the London pool to the Far East. So you're seeing there is cheating at all levels, and there will be such shortage of physical gold the day that people ask for delivery against all of these IOUs, including, of course, all the COMEX short sellers. When people ask for delivery there won't be any gold either. That's going to happen sometime in the next few years, and this market will blow up or implode at that point. That's absolutely guaranteed in my view.
Bill Holter was talking about how they're standing for delivery, which is double the mine production in silver and gold, roughly. He says, I think we're going to get a failure to deliver soon, this year, a few months of next year. Is that what's coming on the horizon? That they're going to end up? Nick Beresheff said, well, they can pay in. You're talking about Nick. He could pay in cash. I said, well, if you got a physical market, that only worked one time. We're going to pay in cash. You can't expect people to come back in your bullion market to then you just got a futures market, paper futures market. So is that what's going to blow this up? The delivery.
Well, exactly. And that to me completes the picture, because you had two very good interviews with Bill Holter and Nick Beresheff, and exactly so one of them talked about exchange for physical, that I think Bill talked about, which I think is correct, about 6,000 tons on an annualized basis. That's 6,000. That's almost twice annual mine production. And then on top of that is that we have the ETFs that are actually buying gold, but only paper, and that's also will be. I don't know exactly how much that will be at the end of this year, but that will probably be probably also in the thousands or low thousands of tons. So of course you will have this whole market will blow up, because everybody, and then you have the COMEX, all of that, and all the bullion banks. They're all dealing in paper gold. No one is going to be in a position to deliver this when people start worrying. I mean, gold has now started at the next upcycle, in my view, and we saw the first move from June. We broke this, what I call the Maginot line, the 1350 level. Now we've gone up to 1550. Now we paused a bit. The next phase of this market is starting now, and that's going to go on for a long time and go to levels that will be hard to believe today, Greg.
You think that we are the lows are in for gold?
Absolutely, absolutely. I think so. I think so. I think we are now going to start the explosive phase of gold and silver. Silver will go even faster, a lot faster. And of course, that even there, interestingly enough, I hear reports both from Australia, from the Perth Mint, and I hear reports from Europe, and also actually from the refiners in here in Switzerland. Silver is just a byproduct, so they're not really silver is not their main business. Gold is the main business, so silver is the byproduct. But they have already now they're seeing a massive demand of silver and big backlogs of silver. Interestingly enough, whilst that is not the case yet in gold, it will come in gold too, because the paper gold market is so big, so people are delivering paper instead. But so silver is already there. Now we're seeing shortages or delays already, production delays or delivery delays, which is very interesting.
Is that what blows this up? I mean, my question just to close is what is the one thing you think? Okay, this is what's going to blow this up. I mean, there's a lot of weakness. The Deutsche Bank's weak. They're printing money and negative interest rates in Europe. They're printing money. They're having trouble in the repo market in the United States. You know, there's all this massive debt. What is the thing that blows this up? What's the one hole in the dike that starts the whole thing going?
You know, Greg, the risks and the bubbles in the world are so massive, so it requires nothing to get this going. And I always say that the catalyst can be anything, something that is not connected to this at all. It can be a debt default. It can be some local bank somewhere having problems. So it's not at all certain it's going to be something major. All you need to know, and this is what we are telling people, all you need to know that the risk is greater than ever that something's going to happen in the next few months or in the next few years. And therefore, for the few people who have some spare capital, own some gold, own some silver, keep it outside the system, keep it out in other ETFs, have physical. I think it's no use trying to predict what will be the trigger. I mean, the reason, as we know, is the debt bubble. The reason that it will happen is the debt bubble and the sheer weight of the debt. The world can never continue to grow, Greg, without this debt of the global debt of 250 trillion, plus the derivatives of 1.5 quadrillion, plus unfunded liabilities of another, at least probably half a quadrillion worldwide. The world can never continue to have solid growth before this debt has imploded, in my view. So that is actually long term. That's the only way that this can happen, and it's actually the best way also, because at some point we have to get the forest fire and start with new green shoots again. The transition will be terrible, of course, and people will suffer in the meantime, but I don't see any other solution to this. So I think it will happen, and the reason why it starts, etc., is irrelevant to me. The risk is there, and that's what people should worry about, nothing else. Can I just say, also, I know people say, "Oh, now he's been on again, prophet of doom and gloom," but it's not. They might sound like, but I'm not a pessimist. I really enjoy life, and only thing I'm trying to do is to identify risk and identify the downside, what's going to happen, and then help a few people to at least protect in some minor way against this. There'll be much more important things than just having gold or protecting your wealth, because the thing in life is family, friends, helping others, etc. And that's what people should think about, because we will all need each other in the coming years.
The answer, people say there's no answer to this. Yeah, the answer is for the debt to be wiped out. I mean, that's the simple one sentence answer. The debt needs to be wiped out. Is
exactly.
That right?
Absolutely right. But the debt can only be wiped out by also wiping out all the asset values. You can't just make the debt disappear and the assets stand there at the values that they are today. It just doesn't work that way. We've had free money and printed unlimited amounts of free money now, and that has created free assets almost.
Yeah.
You created, with this printed money, you created assets that are not worth anywhere near the amount of money that they're valued at today. So when that debt is written off or implodes, or whatever they want to call it, that means that all these assets are going to go down by the same amount. That's why I'm saying it's going to go down by 95% in real terms against gold, etc. There is absolutely no other way, in my view.
The assets will be wiped out. This includes derivative, the ounces of gold, bars of gold. They stay the same. They're constant. They don't get wiped out.
Absolutely, no, absolutely, yeah. This is the simple thing with money. Money as only gold is the only thing that has remained money throughout history. Money is gold and nothing else, and therefore gold will maintain its purchasing power. And the world will have some very difficult years ahead.
For the little guy, just trying to dollar, people say, "Oh, I can't afford gold." Okay, buy an ounce of. You can buy a silver eagle for 20 with a commission, 20. I don't know, $21 an ounce. Go buy a silver eagle every week or every 2 weeks when you get paid. You got $20.
Yeah.
I mean,
or you buy a gram of gold. A gram of gold is for $50. If the Venezuelans had bought 10, 20 years ago, a gram of gold, the ones who did, they would have had food for the rest of their lives today. And that's what so small money then, because then 20 years ago, a gram of gold was only a few dollars. And so that people think that, he talks about this, it's only about big money. It's not about big money. Everyone can save, as you rightly said, buy a piece of silver, buy a small piece of gold, and buy it instead of your coffee, your expensive coffee, or your cigarettes, or your beer, whatever you drink.
I mean, if you'd have been doing this, since 2015, every couple of weeks, you'd have 25 ounces, a year, and then to 2016, another 25 ounces, and 17, 20, 18, 20. You'd be sitting on 100 ounces of silver.
Yeah.
And all you had to give up was some lattes and some cigs.
Exactly. Yeah, people don't realize, you know what? The whole ethos of saving is just something that people don't know about today. It doesn't exist because this is now a world of spending and printing money and borrowing money. But saving, if you save, our compound interest, it's so powerful. If you just save a little bit every day or every month and every year. Now, of course, you're not getting any interest, but has never been like that before. We always had a return on our money before. And compound interest is so powerful, actually. So if you save a little bit every day and you build it up so slowly, it grows so quickly. But nobody has that. Art is totally gone. And governments are doing everything to discourage it by their negative interest rate. That will stop, and it will stop in the next few years.
All you have are ounces of silver, ounces of gold. I mean, that's all you got. Half ounces, whatever. I mean, grams.
Yeah. Well, grams.
For common people, dummies like me, just buy an ounce of silver. Buy, 3 Kennedy $half 64 or.
Yeah.
I mean, people always ask me, what should the little guy do? Save, buy food, right? That you can store, right? I mean, this is going to get bad, isn't it?
It is going to get bad, and as I said, that there'll be more problems than just saving your money and owning gold and silver, as I said, and that's where we will need each other also, and that's going to be a very, very important part of the coming years. The strength of your group around you, but at least protect yourself with having some real savings, because your bank savings are going to go. First of all, they'll be debased or depreciated away by printing. Secondly, the banks might not survive at all, the way I see the world. Thirdly, you will have pensions will disappear, because pension funds only have first of all, many of them are unfunded or underfunded,
right.
and they have 3 bubble assets: stocks, property, and bonds. They will implode in value. Social security, governments will not be able to afford social security. So, people will have to look after themselves. And if they don't think about that today and save a little bit, whatever they can save, people are going to have a tough time in coming years, very tough time.
Egon von Greyerz, Matterhorn Asset Management. You are the founder, the creator, the chief investment officer. You're the man. Can be found at goldswitzerland.com. And just so you know, for a long time you had Matterhorn Asset Management or Matterhorn.com. It's all goldswitzerland.com. That's how you find Matterhorn Asset Management, just so you know. One website, goldswitzerland.com. One company, Matterhorn Asset Manager. One, the man, Egon von Greyerz. Thank you for joining us today on USAWatchdog.com.
Greg, always enjoy talking to you. Thanks very much.